Hello everyone and welcome to today's Connect Global Group webinar on exposing operational challenges in managing intraday liquidity as part of our Treasury series with SmartStream, and this is the European edition. My name is Dill from Connect Global Group, and it gives me absolute pleasure to welcome you all to today's webinar. Before we begin, I'd like to cover just a few basic housekeeping items with you all, and then we can get started. At the bottom of your screen are multiple tools that you can use, and all of these tools are resizable and movable, so feel free to move them around to get the most out of your desktop space. You can also expand the slide area or maximize that to full screen by simply clicking the arrows on the top right corner. And if you have any questions during today's webinar, please do submit them using the Q&A tool on your screen. We'll definitely be making some time at the end of the discussion to take your questions, so please feel free to submit those throughout the discussion. There's also some supporting resources available in the resource list, which we encourage you to download if you find those useful and share those with others in your professional network. For the best viewing experience today, we recommend using a wired internet connection and also closing any programs or browser sessions that may be running in the background and could cause some issues. And if your slides slow down or get stuck, then simply refreshing the page or pushing F5 on your keyboard will do the trick. You'll find some additional answers to more common technical issues located in the Help tool at the bottom of your screen as well. Lastly, a reminder that today's webinar will be recorded and will be circulated to everyone within a few hours after the webinar, so you'll be able to watch that back at your convenience. With that, I'd like to now hand you over to our moderator for today's discussion. Over to you, Nadeem.
Thank you, Dale. Good morning, everybody. I'm delighted to be hosting a panel to discuss the challenges around intraday liquidity and the impact of managing intraday liquidity around the pandemic and the issues that we've seen on COVID-19. But also we'll look forward to discussing a bit more about the day-to-day challenges and what are the new emerging technologies coming down the line, and some of the things that our colleagues are going to be looking at in terms of managing the challenge of intraday liquidity. I've been joined by a distinguished panel. I'll allow them to introduce themselves. Chris, would you like to start?
Hi, Chris Wilgross, Head of Global Markets at Commerzbank. Been there for about 12 years after 30 years of working in commercial banks in the City of London. Commerzbank, its chief focus is on making payments into emerging markets, and clearly intraday liquidity is a huge challenge for us during these times.
Tim, would you like to introduce yourself?
Thanks very much, Nadeem. Yeah, Tim Hardacre. I run intraday liquidity management for Deutsche Bank. I've been in DB for about 15 years, about 20 years in the industry, and looking forward to discussing this topic today.
Thank you, Tim. Andreas, would you like to introduce yourself?
Yeah, thank you, Nadeem. My name is Andreas Biewald. I'm focusing in Commerzbank's Treasury on intraday liquidity and infrastructure. Been with the bank for more than 30 years, 25 years in Treasury. So liquidity and especially intraday liquidity is close to my heart.
Thank you, Andreas. And David, would you like to introduce yourself?
Yes, thank you. I'm David Fraher. I look after funding and liquidity management for Barclays UK. So that's the ring-fenced retail side of Barclays. Prior to that, I've managed funding and liquidity across various banks in Europe and the UK.
Thank you, David. And Philippe, would you like to introduce yourself, please?
Sure. Hi, Philippe Rosset. So I'm Group Treasurer here at Bank Pictet in Geneva in Switzerland. In that position since the beginning of the year. Prior to that, I was at a large Swiss bank for 20 years, mostly in New York City, in the field of Treasury, ALM, liquidity and funding, both front office roles and also more like governance and stress testing roles. So been touching intraday liquidity from those different angles.
Thank you, Philippe. And my name is Nadeem Shamim. I head up the cash and liquidity proposition for SmartStream. SmartStream is a provider of intraday liquidity and cash management software with a significant client base of global banks. I've been in cash and liquidity space for the last 30 odd years, having had senior roles at Standard Chartered, JP Morgan, and ABN AMRO RBS as well. I've been at SmartStream for the last 2 years. And I'm delighted to be hosting this panel discussion. As you'll probably agree and aware of, banks are at different phases in managing their intraday liquidity. Some are at the beginning of their journey and have focused on managing their external positions. Others have sophisticated solutions in place for quite some time. Either they've built it themselves or they've purchased through vendors like ourselves. Regardless of where they are in their journey, COVID-19 has presented many challenges that are both personal and financial. The pandemic has had a major impact on how bank works in terms of meeting its obligations, not only to its customers, but it's to staff and also to regulators. During these times, central banks have helped banks. They've injected significant amount of liquidity. We heard only this week that PRA is going to be, the Bank of England is going to be injecting more liquidity as well. And to help this fluctuation of available liquidity. Some banks have in fact deferred or eliminated paying dividends so they can preserve some of that liquidity. Regardless of that, I think there is extra focus on liquidity risk, on credit risk, operational risk, and market risk. That does not change. Banks, although central banks are comfortable in terms of making sure that there's liquidity, their stringent reporting requirements have not been taken away or alleviated, I should say. But that does not mean that they are pushing a certain amount of reporting requirements further down the line. Regardless, banks still need to manage their risk in a more proactive way. And in this case, there's also a significant amount of operational challenges that banks are seeing, especially with staff dispersed, working from home. All of us are sitting here in our homes addressing this issue on a panel discussion. Similarly, operations are dispersed all over the place. So business continuity process has meant that there's extra forces, extra pressures on day-to-day working, which tends to be for a short period, has been extended for a long period as well. And again, with that in mind, the question is, how do I engage with my regulators to ensure that the stress conditions that are being seen and the stress testing that I do is done in a more active way? Not only make that as a more of a regulatory reporting requirement, but it becomes a day-to-day framework of managing liquidity. So that's just setting the scene as such. What is key right now, and I look forward to hearing from our panelists as well, is that banks need to understand which one of its roster agents, clients, banks are potentially cause of liquidity risk. This is becoming quite key from what I'm hearing, but I look forward to hearing more detail. With that in mind, there are a few set of questions that I'll pose to our panelists and get their view. So one of the things that has come up is to say, what are the emerging challenges and best strategies are there to achieve efficiency in active liquidity management? And with that, why is managing cash and liquidity accurately so important in a state of flux? Could I ask David to give it a go and start off our discussion?
Yeah, Nadeem, no problem at all. Thanks, and thanks for the introduction. I think that's some really helpful context. Look, I mean, to answer your question in a word, I'd say confidence is the reason this is so important at this time. You know, intraday liquidity is really about kind of making sure that the wheels of the system and the way that we interact with each other remains kind of viable, and we need to have that kind of shared confidence right across the industry. So, you know, being accurate and sure about your positions, particularly in a period of stress, I think is vital. I mean, obviously it's important at all times, but you know, you just have that heightened focus when the stress comes in. I mean, interesting, as you were giving your introduction, one of the things that I was thinking about was, you know, as liquidity managers, we tend to like to have as much liquidity in our remit in our world as possible. And something I've kind of had to challenge myself on actually through the pandemic is whether or not that's really the right answer. You know, clearly what we want to do is actually make sure, yes, that we're safe and that we're secure and that we're able to kind of keep the systems open and free flowing, but also to make sure that, you know, we're actually providing, you know, cash into the real economy through our business lines as much as possible. And therefore, you know, accurate management for me isn't about just ensuring you have enough. It's also about making sure you're not hoarding too much. But you know, you need to get that balance right in order to make sure there's enough confidence flowing right through the system to make sure that things keep ticking over.
Thank you, David. With that in mind, do you think COVID-19 has created challenges in meeting those obligations that you have? And if that's the case, what lessons have been learned with the reduced resources that are available, not necessarily on the liquidity side, but in terms of people?
Absolutely. So, yeah, I mean, it's interesting, you know, sitting here in a ring-fence bank. I've actually experienced so far, and I'm desperately looking for some wood to touch, so far a fairly easy ride through the pandemic process. What we've actually seen is a fairly big build of liquidity, and as the UK went into its early lockdown, a sharp decline actually in customer activity, which is the main driver of my intraday requirements. So from a ring fence bank perspective, you know, whilst accuracy and reporting and what have you remains vital, and I'll touch on that in a minute around the resources piece, the availability of intraday liquidity has actually remained fairly robust. Now, you know, if I look across the ring fence to my colleagues in the non-ring fence bank, I think what they've experienced is much more different, because those large corporate customers have, you know, they've retained their need for cash in the system, and in fact, what they've done is, by managing their own liquidity positions, probably put a bit more stress on the non-ring fence bank intraday position through the use of revolving credit facilities and contingent lines in a way that, you know, we haven't, or we wouldn't normally see and haven't predicted. So kind of a tale of two halves really in a large UK bank. In terms of, you know, resources, that's obviously a topic we may cover a bit more detail later, but you know, that's been a stretch, absolutely.
Thanks, David. Similarly, Tim, do you have some thoughts on this particular topic as well? How does Deutsche manage this?
I would mirror a lot of what we heard from David. I think it's interesting to see that the two effects that we saw from COVID. The first piece was that I don't think any of us would have predicted we'd be here today 12 months ago, and therefore the stresses that we saw coming through late Q1 was significant. We saw a really big pull on revolving credit lines, the kind of corporate lines which we see across large commercial investment banks. Now, in terms of day-to-day intraday, I think a lot of the banks held up pretty well, actually. And surveying other market participants, it was clear that actually, largely the intraday processing and payment systems work quite well. We didn't see stresses on the financial institutions themselves, although that was passed through to the corporate clients who wanted to get their hands on liquid cash to see them through, particularly airlines and various other sectors. So I think it was a very interesting thing to have gone through. I think what it also highlights is another aspect, which is stress testing and the outputs that we see in trying to calculate stress models. You can only go so far, and you need to be careful about what you calculate as your stress buffers.
That's a very interesting comment that you make in terms of the stress testing itself. That the previous models that existed were based on the previous crisis, right? And what this pandemic has actually exposed is those particular models are not necessarily valid or workable in this scenario. There is sufficient liquidity, but the uncertainty of who would be draining that liquidity has not been captured in the previous model. So I guess banks need to be much more agile in evaluating that stress. Chris, how does Crown Agents had seen the issues on intraday liquidity during pandemic?
Yeah, from our side, and the challenges we face are different from the guys in the major clearing banks. For us, it's we are fairly liquid bank. We're liability driven, so for us it was mainly just making sure that we kept ourselves safe. We were our HQLA was what we thought it was. We were having daily ALCO meetings when the pandemic first hit, just to look at what we had on the asset side against any potential withdrawals on the liability side, and we made some decisions about moving from one currency to another. We had a lot of Bank of England reserves, but a lot of dollar liabilities, so we kind of got a bit nervous that we wouldn't be able to swap those. So yeah, for us, it's and to your point earlier, it's not only being confident in ourselves that we are we're liquid, but it's becoming increasingly important to be able to demonstrate to the regulators that what we're doing is fine. And in terms of stress testing, there's nothing like going through a stress to make you evaluate what you're doing, what you've got in place, and how you need to update those.
Thanks. Yeah, I totally agree. Philippe, maybe I can move on a different question to you. How do you ensure that the intraday liquidity is not simply a topic for Treasury or regulatory reporting, but it becomes a wider firm topic?
Yeah, I think it's certainly key, right? Because to manage it properly and to optimize it, you really need to have like everyone pulling at the same rope there, and you need help from people in operations, people in the business lines, and people in Treasury, of course, being involved, risk, and so on. And you won't really get to it starting from Treasury. I think you have to go 1 or 2 levels up and then bring it down across the firm. And so I think it's really a topic to bring to the ALCO, to get the buy-in there, to demonstrate that it matters, that also it's a big risk. It also has a large cost associated with it, and that you need essentially the ALCO to sponsor projects around it, and also to identify in the main partner functions, again, may it be ops, may it be the business lines, partners with which Treasury can work to really better understand and then optimize intraday liquidity consumption.
Right. So that would mean that there has to be a significant amount of operational connectivity between the organization, and that can create a lot of friction and additional cost. How do you ensure that these operational efficiencies are in place that will help reduce the costs or lower the risk or address the regulatory needs?
Yeah, I think one good way basically to have people around the table, right? Especially to have the business lines joining the effort and being very interested in that topic. You won't be surprised would be funds transfer pricing, right? To the extent you are able to show the cost of intraday liquidity consumption and allocate it not to a very high level where it's, you know, broad brush, but actually to a level that is fair enough for businesses to be able to understand and, you know, optimize from there. So I think funds transfer pricing is key to get the business at the table. When it comes to the ops department, there's maybe a mentality shift to put in place. Ops have for the longest time worked with, give me whatever resource I need to avoid fails, to get those trades settled. And now you want to have the discussion to bring that intraday liquidity to the equation and say, well, avoiding fail is of course important and still high on your list, but can you do it more efficiently? Do you need to consume that huge amount of intraday every morning to make sure you settle, or can you do it in a more optimal way?
Yeah, that's similar to what David was saying earlier on in terms of leaving a large chunk of liquidity is effectively what you're saying is a passive way of managing. You need to be more proactive and not waste liquidity, even though there is a significant amount of liquidity sitting around. And Chris was saying that his bank has plenty of liquidity as a different model, but still wasting liquidity is something that is no longer considered as operating model going forward. So that actually takes me very nicely in terms of onto the next topic that I wanted to address. And Tim, maybe I can start with you. It's you know, what are the trends and developments that you're seeing in intraday, going from straightforward knowing what it is to what is the next thing coming down the line for you?
So I think there's a few things to say on this. I think the interesting thing we're seeing develop now is, of course, instant payments, 24-hour payment windows, or at least expanding payment windows. That's clearly an emerging aspect of the market that we need to look at. I think the other element is that we have significant amounts of effort being expended on meeting regulation, which of course is important, and we need to do that. But touching on the topic we were just discussing a moment ago, I think the operational effectiveness is really key, because it's fine to meet the regulation, and of course that's what all banks are striving to do most of the time across a variety of frontiers. But in the case of intraday, if you can't line up transparency through to your businesses in terms of the way that the consumption of intraday liquidity is seen and understood within those businesses, you're not going to get the front to back connectivity that allows Treasury and operations and IT and the businesses to actually work in concert. So I think that's very important. And as we move into the emerging aspect I mentioned at the start with 24-hour payment windows, that can probably, I think, only lead to two things, which is greater volatility and less certainty. Now, if we stay in status quo, I think that's going to mean that that can only increase the kind of buffers that we hold, because uncertainty and greater risk is going to drive in that direction. And for that reason, the connectivity with operations, technology, businesses, and so on has to increase to allow us to pull back the other way. And I see those as two opposing forces, which we're going to need to reconcile over the coming years.
Thanks, Tim. I think what you said, and a couple of things which kind of picked up. One was definitely in terms of front to back, and then looking at, similar to what Philippe was saying, on funds transfer pricing in terms of what is the value for each department and how you can allocate the cost. The other thing very interesting is around the faster payments, real-time payments. And I want to take that and ask Andreas on his view. You know, how is the intraday liquidity impacted by the impact of faster payments?
Yeah, thank you, Nadeem. I think instant payments will be soon the new normal in the payment environment. So we have to implement a new payment channel to our liquidity management, especially to our intraday liquidity management. There will be some volatility challenges, as Tim rightly mentioned, but we should take into account that the new channel will be implemented in our existing environment in a very proper way, and that we have to take care on that we are pooling our instant payment liquidity in the right place. Here, the ECB came up in summer with especially for Euro, with from my point of view, very good opportunity to connect to TIPS by the end of next year and being reachable across Europe. So this for us has two advantages. We constantly keeping huge central bank liquidity buffers, especially in Euro, and we're getting a payment channel which is consuming intraday liquidity in central bank money. That's important. This has two advantages. We are currently benefiting from a minimum reserve interest rate and a so-called tiering interest rate, where we're getting some compensation for holding all this surplus liquidity within the Euro system. So a nice spillover effect of this fact, which is most of the case, the fact with all of the banks, is that we could reuse our surplus liquidity on ECB level in order to get the payment flow running and in order to have enough oil in the system. Given that there is such a huge amount of oil in this engine from a central bank money point of view, I wouldn't call it's a free lunch, but it's a huge advantage feeding instant payments via a central bank money system. So for us, it's important to connect to the right system, having the right timing, and implement it in our liquidity management properly with the right interfaces in order to keep track on the overall liquidity of the bank and in order to optimize further intraday liquidity, even in a faster payment environment. And then the volatility will be less of a problem.
Thank you, Andreas. I wanted to put a kind of a contrary question to you, because there is a school of thought that to manage intraday liquidity on the back of faster payment, well, the reality is you have to pre-fund that account anyway. So is it a real-time liquidity management issue, or is it not? What are your thoughts on that one?
We all know we have a lot of statistics on our liquidity profile for the last decades. So not every payment is completely new for us. We know from our customer profile when we have huge outflows and inflows during the month. So simply nothing is changing. We still have the same inflows and outflows on certain days. So the procyclicality or the balancing factor of inflowing and outflowing payments doesn't change. It's just the way they are operated. And one should not think that only the outflows are gone immediately within seconds. We will get inflows immediately within seconds, and the profile in general won't be changed. So therefore, I have no fears that the instant payments will lead to a troubled liquidity management on our side.
Thanks, Andreas. Chris, can I pick up the same topic with you to say, what do you see there is a challenge that needs to be addressed in accurately forecasting liquidity with real-time transactions and payments as they spread across the globe, which all of our panelists seem to think that it would happen?
Yeah, absolutely. And from our company's point of view, most of the payment services we're offering are in emerging markets, and that offers or brings up different challenges. Clearly, these funds don't get paid unless the funds are on the account. And to Tim's point earlier about how using up liquidity or how costly holding liquidity can be, clearly that's a challenge that we've got. We have to balance that out in terms of we're offering payment services to countries where there are challenges, and we know that the funds coming in on the other side can sometimes be a challenge. We've got quite important critical payments to go out on the back of that. So more and more making sure that we're funding these accounts and being able to fund these accounts and knowing when the payments are going out is going to be critical for us. And in a lot of these areas that we work, it's the automation isn't great. It's getting better, but it's clearly something we're going to need to work on. Again, we're trying to offer 24-hour payment services in countries where settlement is a challenge.
Thanks, Chris. So clearly, what I'm hearing is that there is a challenge of creating an automated solutions from front to back, whether you're looking at internal operations, whether you're looking at how you engage externally, whether it's to do with payment system or regulators. Let's have a little conversation around what are the emerging technologies that you're seeing to achieve the efficiency and the compliance challenge that we have. Andreas, can emerging technologies have the capabilities that can help you address these challenges of tomorrow?
Yes, of course. That's the reason why we're developing them. And I have the following vision. I see on the retail payment and on the retail payment side, instant payments being the new normal, as I already mentioned, and that will cover most of our bread and butter payment business. On the more advanced high volume payment side, I always call it the MT 202 world, I see the need for a digital solution. Digital solution means for me, we should engineer tokens who are based on central bank money, and we should exchange more and more liquidity via tokens, especially in the FX business, in the PVP business, as well as on the security side in the delivery versus payments world. We have huge amounts of settlement going through in a very old-fashioned way. So our liquidity is not in one place. It's designed on various places and intermediaries. It's blocked and unencumbered in certain custodian accounts. We always have to pay liquidity towards these sub hubs of our main hub. So therefore, I see a central bank clearing and central bank settlement like T2S in the focus, consolidating settlement in one place, having collateral and cash in one place via instant payments available all around the clock, and reducing intermediaries and reducing the number of sub-liquidity pots we are currently managing in the not most efficient way. So from the digital point of view, for example, euro-based token, central bank money-based token would be ideal for the interbank world. And instant, I think, in the retail world is matching most of the payment cases we currently have. So it's a mixture of instant payments and digital payments. And maybe what I haven't discovered yet is the possibility to combine via API in the instant payment tips liquidity with digital solutions.
That's quite an interesting connection that you've made in terms of connecting the digital with the instant as well. I think that's something that definitely is going to come further down the line. Chris, I mean, you have a very different business model where, as you said, you're making a lot more cross-border payments and markets where where some of the infrastructure doesn't exist. What are you thinking in terms of the emerging technologies that you'd like to see or you'd be looking to implement?
Yeah, well, mainly we've got the technologies on the buy side. So our clients who are looking to make the payments into these regions, we've got API connections. We've got people who can source an FX price and order the payments. It's digitalizing the other side of that is going to be the challenge for us. And we're working towards that. We've bought a new payment system where we can send bulk payments into the regions. But the challenge for us is that our local banks in these regions can take these bulk payments and can distribute them. So it's about coming up with a seamless, straight through from the client through us to the local bank. And we're working towards that, but that's the main technological gain that we're going to have to improve on over the next year or so, or longer.
Thanks, Chris. I've got one more question that I'll pose to Tim and to Philippe, and then we'll wrap up and add some time for questions from the audience. So, Philippe, in similar vein, what is it that you're looking in terms of new emerging technologies going forward? Whether it's something to do with combining the operational data with the financial data. I think that was something that we discussed earlier on.
Yeah, absolutely. I think banks, for the regulation perspective and then for their own interest, have to invest, right, in monitoring intraday liquidity. And I guess each bank can choose for itself whether it wants to, develop something on its own. But I think it's really something that goes for very large institution, or then buy something off the shelf. But then do you want to just check the BCBS 248 regulation and be happy with it, and just, or do you want to actually gather enough information to really optimize your consumption of intraday? And I think there are different products for different objectives there. What I find very interesting is any tool that can reconcile the ops data, so like your Swift messages and data that is typically using a different vocabulary, let's say, than the one that you're using internally in your general ledger and in your finance systems. And so in your ops area, when you see a Swift payment come, you know where it's coming from but who it's for, maybe as a client, but you don't quite know what happened in the back that triggered that cash flow. And if you can reconcile your ops data to your finance data, there you start to have really much more information in a format that you're used to, because it's the finance format that you are using within the firm. And then that allows you, first of all, it's very helpful also for funds transfer pricing, again, because now you can pinpoint to your organization where the consumption is coming from, and also then, of course, to engage people more directly to their activity and the way they can improve it. So I think that link is really important to create, and it's not that straightforward because, again, it's two different languages that need to speak to each other.
Thanks, Philippe. And so I guess, Tim, does that mean we should be, as a bank, we should be looking at an enterprise-wide solution?
I think enterprise-wide, insofar as the departments and parties interested in the topic. So yes, absolutely. I think the thing, building on some comments that Andreas and Philippe have mentioned here, I think there's a role here to play for artificial intelligence, and I think the forecasting element of this is critical. I think regulatory compliance, in terms of meeting the pure regulation, exactly as Philippe says, you can tick the box on that and that's fine. But if you're halfway through the day trying to forecast your end of day position, what you really care about is the ability to forecast that accurately. And if you can do that and demonstrate that, then of course you can keep your liquidity pool sufficiently low to grease the wheels, but without overdoing it and therefore reducing your costs. So I think there's some products in the market at the moment around AI, which look at behavioral characteristics and the kind of historic lookbacks that we see in stress modeling, but overlaying that with some extra dimensions, which I think will give very good forecasting abilities, allowing that end of day position to be forecast earlier in the day, and managing your liquidity buffers to a pretty fine level of detail.
Thanks, Tim. In fact, you've just answered the next question I was going to ask in terms of what is the next bit of technology that you're excited about, and AI clearly is something that has caught your attention. David, would you like to say the last few comments on where you think is it exciting technology?
Yeah, absolutely. Kind of flipping from the beginning point, I'd echo a lot of what Tim just said. I mean, behavioral analytics, I think, just offers a huge opportunity to just squeeze that extra bit of efficiency out of what we're holding for intraday liquidity. And I think the challenges will be kind of taking all of that new modern technology and actually linking it into some of the perhaps slightly older technology that banks are running with at the moment. But the opportunities are huge, I think, in the AI and behavioral analytics space if we can just harness the information that's coming out of it.
So we've got 2 for AI and behavioral analytics. Andreas, what are your thoughts?
Forecasting the flows has a certain component on your intraday liquidity stress testing, and I agree with Tim and David that we need to keep the buffers under control, and these buffers are extremely expensive, and every tool which helps us especially to reduce the stress buffers is highly welcome. So I think it is up to the regulator as well in order to pave the way a bit towards standardization in intraday liquidity stress testing. Basel 248 has no specific, not really a specific requirement, and leaves pretty much room open for the banks how to do that. And here I see, after some experience with Basel 48, a reason to harmonize a bit more what the regulator wants here and requires, because sometimes I think the internal requirements are higher than the regulatory requirements, and some more look through would help us to come here, especially with a stress test buffer, to a more normal level.
Right, thank you. So we'll go 2 for AI, 1 for stress testing capability. Chris, what are your thoughts?
I'm kind of in the middle of. I think we've, in terms of our stress testing and the analytics we've done around intraday liquidity, there's been a lot of heavy lifting from our side, a lot of analysis, looking at the behavioural content of our accounts and ins and outs. We've also got a PRA intraday liquidity return that we're trying to work on, which kind of gives highs and lows, but again, I still don't think it does exactly what we needed to do. I think that as much as I'm going to come down on the side of AI, something that could really give us more efficiency, because at the moment the amount of liquidity we're holding, the internal buffers that we're putting on top of what we already have are quite restrictive in terms of what we can do with our balances.
So 3 for AI, 1 for stress testing. Philippe, what are your thoughts, your final few words?
For the sake of adding 1 to the list, I would say, there's certainly a lot of work being done in terms of, well, we mentioned instant settlement, right? Instant payments, which has its risk on one side. You may lose liquidity maybe faster than you were planning to, but as also opens the door for products that haven't existed so far, which is maybe like a market for intraday liquidity. And I don't think it's tomorrow. I don't think it's next month. But there are efforts in the industry, in the fintech area, to try to develop such a market. And instant payments, basically the ability to exchange hands immediately, really could create that capacity to and also help potentially reduce your buffer, because there's an active market where you can compensate for unexpected outflows. So I think it's very exciting. There's a lot of hurdles to it, but yeah, something to keep an eye on.
Sounds like an intraday repo market that you're looking for. Andreas, do you want to add something to it?
It's a very interesting comment of Philippe, and I think we are talking about this intraday liquidity market for many years already, but instant payments should offer us the right tool to process these in a 5-second processing in time environment. So I strongly agree with Philippe that there is a market, and not all our profiles are the same. We have different customers. We are coming from different areas, investment bank, retail bank, and there should be opportunities out there to balance our intraday profiles on a market. And I think with instant payments, we have a tool to do that within seconds. Yeah. Whether we should do that via a repos, I often was thinking about that as well, because it has some real-time cross-settlement component we could easily fulfill with repos as well. So once the liquidity is in one place from a central bank eligible collateral point of view, i.e. target 2 securities, or from a cash point of view, i.e. instant payments, then it doesn't matter which tool you are using. Ideally, both would exist.
Great. Well, this has been a fascinating conversation. I've really enjoyed talking with each one of you gentlemen. Now we'll, and thank you very much. Now we'll have some time for questions from the audience.